Good afternoon, everyone, and welcome to this final session of our spring conference. In a moment, we'll be hearing from Philip Waller, who will talk to us about JPMorgan Global Core Real Assets, or JARA. Phil is a member of the Alternative Solutions Group, JPMorgan, which manages the trust. JARA launched in September 2019 and aims to generate a 4 to 6% dividend yield and a 7 to 9% NAV total return from a diversified portfolio of real assets sited around the world. As of yesterday's announcement, 91% of total net assets have been invested, and the trust trades on a 9% premium. Phil will speak for around 30 minutes, and then we have around 15 minutes or so available for questions. Please put your questions in the Q&A function to the bottom right of your screen. I will collect those and put them to Phil at the end. And so with that, I will hand over to Phil.
Brilliant. Thank you, Tom. And yeah, here I am, the last session of not only the day, but of the event. So thank you for those who have stuck with it. Thank you for coming in. So yeah, as Tom mentioned, with JARA, we launched back in September 2019, which obviously compared to maybe some of the investment trusts you've seen today means we've got a relatively short history. But nonetheless, we are built off JPMorgan's alternative platform, which hopefully is a positive. We've been managing alternatives for 50 years. We've been managing multi-alternative products like JARA for 10 years. And so a lot of heritage behind what is going in with JARA. When we launched, really what we were looking to design and offer people was that kind of cornerstone allocation within their kind of alternatives or their real asset buckets. I think you get that cornerstone nature with JARA in a couple of ways. One, we are very, very well diversified. So firstly, you have that diversification across different types of real assets. So we're not just a pure real estate play or a pure infrastructure play. We have diversification across real estate, infrastructure, and transportation assets, really the kind of three big food groups of the real asset market. We also have global diversification. So really looking to complement a lot of the very good but very UK-focused real asset products out there, really providing a global solution for people for that cornerstone within their portfolio. Last thing to say on the cornerstone side of things, we are focused on what we call core real assets. I'll define this more in more detail later. But really what it means is we are focused on more income-producing assets that are typically in high quality locations, using longer term contracts, and therefore hopefully able to provide us a more consistent return, which is important if you're using it as a foundation within the portfolio. Obviously, real assets, again, talk about this in a bit more detail, really meet a need both in the short term and the long term, in particular, that need for income, that need for diversification, which I think is at the top of a lot of investors' mind. With JARA, what you get is access to an established platform. So we've been managing, as I mentioned, real assets for 50 years. We are building JARA's portfolio using the private funds and the private strategies that have been on that platform for, in some cases, decades. And what that means is even though JARA is now roughly 200 million, we get access to a much, much broader pool of assets using these existing strategies. And we have over 700 private assets in what we currently do, which is a really, really strong number in terms of reducing idiosyncratic asset risk and all the benefits that come with that. Target return 7 to 9, 4 to 6%, which Tom has previously mentioned. So I want to start off by touching on a few slides which really hopefully kind of make the case for why so many investors are focused on adding real assets into their portfolio, whether they're institutional investors, whether they're fund managers, or whether they're private investors. Real assets are a big focus across a lot of market participants. And I think this, first slide kind of does half of that story. What's going on in the more public markets that means that people are looking to an asset class that they maybe wouldn't have looked at several years ago. Well, firstly, obviously, with government bond rates and government bond yields being where they are, it's quite a challenging environment for more traditional fixed income and core bonds. The traditional income benefits, the traditional diversification benefits are probably less likely going forward, given where rates are and given where they are to stay. Doesn't mean they're not going to be an important part of people's portfolios, but also good time to look at other options. Similarly, if you look at where equity market multiples are, considering we are early cycle now, multiples are relatively full. And I think this was really shown in JPMorgan's 2020 release of our long-term capital market assumptions. So our long-term capital market assumptions are our paper we produce every year, which is a very diligent look across every single asset class we invest in, across public markets and private markets, to provide investors with a 15-year view of our return expectations. And in the publication this year, bearing in mind we are at the beginning of a new cycle, our view was that a traditional 60-40 portfolio in GBP would return around 3.6%, sorry, over the next 15 years. Relatively modest number compared to what people are probably used to when investing in these markets. If you compare that to maybe the end of the last kind of downturn, so kind of 2008, 2009, our expectations at that point were a plus 6% return for a similar portfolio. So you can see how the various nuances of the market today mean that just investing in traditional assets is a more difficult proposition for people to purely focus on, and hence why real assets and other alternative assets are becoming more and more in focus. This slide, so slide 4, I think really positions and gives a really good view of how we think about core real assets. What we're doing on this slide is plotting a number of different categories on the bottom against their equity beta, and on the vertical axis against their kind of predicted income. You can see that top left-hand corner, so the lower beta, so good diversifiers, higher income part of the diagram is relatively barren. What is in there is core real assets. Real assets will give you different levels of diversification, probably kind of around 0.2 to 0.3% beta with real estate, around a 0 to maybe negative in many cases with infrastructure, and the blended kind of portfolio is what you see there. Something that provides good diversification and a really healthy yield if done in the core way. So I think really good addition to a diversified portfolio for those that need or think about how they start to build that in a greater way. I think the other thing which has actually been really topical over the last few weeks in particular is, okay, how do I look to protect my portfolio against inflation? You can see how markets have reacted over the last few weeks as inflation expectations have moved around a bit. And this is obviously driven by the fact that you've got monetary and fiscal stimulus across the developed world acting in the same direction. You've probably got quite significant pent-up demand from the consumer side of things, and the potential that when economies open up, things will open up at different rates. The supply side may not be able to keep up with that kind of pent-up demand that comes through. That, and you've seen this in the last few weeks come through in kind of market expectations, could at some point lead to a kind of a greater inflationary environment. Now, what we've kind of plotted here is on slide 5 is how have real assets done over what kind of the last proper kind of inflationary period, so 70s and kind of mid 80s. We use US data here because that far back that's kind of the best and most transparent data we have. But what you can see here is plotting against a number of different indices that actually real estate and infrastructure performed really quite strongly and provided good inflation mitigation in what was a relatively strong inflation environment, particularly if you compare it to things like debt and the S&P 500 as we plotted here. On the right hand side, I've kind of plotted why, or said why kind of we think that is. So really it comes from, in particular, where you get the inflation protection within real assets is in infrastructure and real estate. And really a lot of it comes from, firstly, the inflation-linked nature of a lot of the contracts you can get in these markets. The place where this is most prevalent is in the kind of utility market, the regulated utility market, pretty much on a global basis, where a lot of utility contracts allow for some inflation pass-through mechanisms in them. Different countries also have that in their kind of real estate contracts as well. Some countries do, some countries don't. Obviously, JARA portfolio is global, so we do definitely have some exposure there. And again, that gives you some pass-through when inflation starts to hit. The other thing to think about, which is a bit more implicit as opposed to explicit, like you get with the kind of contract adjustments, is how as inflation increases, things like replacement costs go up. That's a benefit to real estate because building new buildings is now more expensive, and therefore it can help support capital values. So generally, people are starting to think about inflation. Real assets are also a good asset class to start looking at because historically they have been able to provide good mitigation against that scenario. I think important point to note here is that JARA is a global product, so we are not necessarily linked to purely UK inflation. Our inflation exposure will be global, but nonetheless, a number of our assets will have that kind of mechanism within them. So hopefully that makes a good kind of case to start with about why people are thinking about real assets and alternatives more broadly in general, and in particular where real assets can be a real key in the income side of things, the diversification side of things, and also to help protect against inflation. Now, getting onto the strategy, I want to start quickly with firstly the JPMorgan Alternative Platform. I want to touch on this because it is this platform that we are using to build JARA. We have a 50-year history. So we've been managing alternatives for 50 years, and we've been managing real assets for 50 years. So quite predictably for JPMorgan, we started with US real estate, and we've built out from there. We have 155 billion in AUM across alternatives. So a really quite significant platform, with actually half of that AUM being in real assets. So I would say real assets is what we're probably best known for, particularly in the institutional market, where we're seeing probably the greatest growth as well, as people chase, the income, the diversification I've already talked about. So with JARA, what we are really bringing to the market is a established institutional platform, which has a lot of capital and therefore a lot of good diversification we can benefit from, to obviously a wider audience. JARA's listing means that it's more accessible to different types of investors. So, as opposed to purely being a pension fund or insurance company type of platform, really looking in trying to provide the option for it to open up to other investors, which I think is obviously a benefit to all. Other big kind of point to talk about with JARA before we get into the allocation is what type of assets are we targeting? We are targeting pretty much fundamentally core assets. What do we mean by core? Because a lot of managers will use this in quite a different way. And actually, I think those that were defining it in our way and more conservative are the ones that have actually done best over the volatility over kind of 2020. So how we define core assets, these are the assets at the higher quality end of the spectrum. So let's kind of think about real estate, for example. You can do assets in a core way, which would be buying in tier 1 cities, well-leased buildings with high quality counterparty. The other way to do it is more opportunistically, which would be buying land and building on that land and selling it for a profit. There's no right way, there's no wrong way, but you can clearly see that there's a way which is more income focused, has less capital appreciation built into it, but nonetheless should have a lower volatility and greater predictability. We are focused at that core end of the spectrum. And importantly, to be a core asset, you have to kind of really touch on a lot of these things that we highlight on this page. So firstly, a majority of the return should come from income. Importantly, that income can't just be a high level though. That income needs to be highly forecastable and highly predictable in nature. So really what that means is we are looking to maximize our exposure to contracted sources of income, whether that's in the infrastructure side where we have contracted or regulated utilities and contracted power, whether that's in the real estate side where we're looking for relatively long-term contracts, or in transportation where you're leasing out your assets for 5 to 15 years. Obviously, when you have that focus on contracted income, you'd like to have good counterparties as well. And if you can't have good counterparties, making sure it's really, really well diversified. So maybe in the residential space where you can't necessarily say to do a credit check on a single family, making sure you've got good diversification so that you have appropriate levels of spread across your different tenants. We focus on developed markets. We are global, but developed global. So US, Europe, and the developed markets of Asia Pacific. And importantly, we focus on core sectors as well. And this is really, really important. I'll talk about this in more detail by asset class later. But what we don't do is really stray into the more esoteric parts of the market. So in real estate, we have quite tight definition of core, not straying into things like hospitality or gaming, parts of the market that are typically less well trodden, and also are more impacted by shifts in economic sentiment or certain regulation or whatever it may be. Similarly, in infrastructure and transportation, that means maximizing our exposure to things like contracted power and utilities, as well as the climate and energy logistics sector within transport. Finally, moderate leverage is important. These assets can take leverage, but not we don't overjuice things, and a relatively low level of development risk. We do take some development risk, which I'll talk about later, but it is a low single digit of what we do. So hopefully you can see that through all of this, what we're trying to build up is a really, really diversified portfolio with assets predominated on getting majority, 2/3 plus of their return from income in a predictable way. And that's hopefully feeding into how a lot of people are using JARA or thinking about JARA within their portfolios. So onto the asset allocation now. So here we have how we're allocated. On the left-hand side, we have our outputs of the portfolio. Target return we've already touched on at the top. The next two boxes on the left-hand side I think are really, really powerful and really, really important to what is relatively unique about JARA. Because we're using the existing platform, so the existing private strategies that have capital in them and assets in them. We get a much greater diversification than we would have been able to get if we were building this portfolio directly with the 200 million or so that is in JARA. We have exposure to over 700 private assets within JARA. It's across 4 different categories: US real estate, Asia Pacific real estate, infrastructure and transportation, and is 70 billion of capital value. So a really, really difficult number to kind of get your head around when you're talking about a market like the real asset market that is lumpy, that is illiquid. To get that level of diversification is difficult. It takes a long time. So the longest strategy we have in here has been going for over 20 years. And it takes a lot of capital, and you can see that it's over 70 billion of asset value. Something which I think in the market is really, really difficult to replicate and is powerful for JARA achieving its kind of cornerstone nature. Right hand side, you see our allocation. You'll see that we have strategic bands. The current allocation is very much the midpoint of these strategic bands, and the bands really allow us to evolve things over time as we see fit. There are 2 layers of portfolio management, if you think about it. There is what myself and my team do. So I'm one of the portfolio managers, and we are driving that strategic asset allocation. How much within real estate, infrastructure and transportation on a long-term strategic basis. We are not making tactical decisions per se, but we are taking a view on where we think the portfolio should be broadly allocated to over the medium term. We then have underlying teams. We have a US real estate team, a dedicated Asia Pacific real estate team, an infrastructure team, etc., that are more focused day to day on the assets. So they are driving the more tactical or the more asset level management. That means that they can underweight retail and overweight logistics, think about leverage levels, refinancings and all that. Going around the pie chart from the top right, so we have a 40% allocation to global private real estate. In a way, that should say global private real estate ex-Europe and ex-UK. So if you look at kind of the 2 bullet points, you'll see that actually we are allocated to only US and Asia Pacific on the real estate side. That's very, very deliberate, trying to make sure that we are a complement to people's portfolios, as opposed to doubling up on all of their UK exposure they may already have. On the infrastructure side, we have an OECD strategy, really, really well diversified across developed economies. We are owning the assets, developing the assets and trying to improve them for the long-term cash flow of them, and not just kind of holding and selling or anything like that. Finally, we have transportation. This is very much a income-focused approach to transportation. Some of those familiar with the industry will think about it as a more opportunistic and cyclical play. We are looking to buy longer-term contracted transportation assets and put them on contract with high-quality counterparties. The Shells, the Rio Tintos, the RWEs of the world, those that like longer-term contracts, it gives them stability in their business and also gives us a counterparty quality that we're looking for. If you do that, you're reducing your exposure to the spot market where you have a lot of the transportation volatility. The nice thing about having this in the portfolio, and it's a probably the least known of the real asset categories, it does give us an income premium to infrastructure and transportation. That's because there's a real need for capital in that space, as traditional capital providers have pulled out. And it means that we can step in and earn a really, really healthy yield, typically north of 8% on a net basis. Finally, from a high level, we have a listed real asset allocation, so 20% of the portfolio. Gives the portfolio a little bit of liquidity, which we can use from time to time for, helping do share buybacks or maybe tactical rebalancing. Also some benefits from allowing us to access some different sectors that are more prevalent in the liquid market, as well as the timing benefits that come from owning some liquid assets in a private portfolio. We actually have seen that more recently, where even during kind of Q2, Q3, where the private markets were still adjusting, actually the public markets were rebounding really strongly. And so it does give you some timing benefits from a volatility and a return perspective. So that's the kind of asset allocation. I think importantly to touch on, why have we done this? Why we think there is a need for such a diversified portfolio. Well, firstly, there's that kind of one-stop shop benefit, which allows investors, particularly outside of the UK, they may feel comfortable about allocating in the UK, but particularly on a global basis, want something which is more of a solution than something which is targeted. We also see strong demand from larger investors that kind of see this as a more foundational allocation that can go and be a strong part of portfolio construction, because it allows them to have a diversified base and then take more tactical or high conviction bets on top. But equally, from our perspective as the team that builds the allocation, in our view, the sum of the parts are greater than the parts individually. And hopefully you can see that on this graph, and I'll take you through. I know there's a lot of data, but yes, real estate, yes, infrastructure, yes, transportation by themselves are good producers and good diversifiers for people's portfolio against financial assets. But there are also good diversifiers against each other. What's going on in the Australian real estate market is totally different to what is happening for a European wind farm. So the returns of the different categories are actually quite complementary as well. So putting them together in a global way in particular does allow you to almost benefit from a double layer of diversification. That means you can hopefully get one or more consistent and steady income because you're getting it from more sources, but equally lower levels of equity beta, lower drawdown because of the diversification inherent within the portfolio. So what we show here is looking at on a back-tested basis how various different portfolios would have done over the last 15 years. Now I don't want to look at the financial on the two left columns. I just want to compare JARA on the far right to kind of a standard global real estate portfolio. What you can see in the kind of JARA column is just how a number of different metrics improve because of that cohesive portfolio that's put together. The one to highlight that makes this kind of the most evident is the second from the bottom row, which looks at max drawdown. So the max drawdown of JARA or JARA portfolio over the last 15 years would have been 13%. Compare that to the whole kind of different solutions we show, but equally compared to global real estate, that is a significantly lower drawdown compared to what you'd have seen in global real estate during the financial crisis. And that's because we've added infrastructure, we've added transportation, we've added the listed side in a thoughtful way that hopefully means we get a more powerful outcome from a volatility and a diversification perspective. So much a bit more detail in terms of what we're actually owning. So firstly, just start off on the real estate side. Do you remember I talked about JARA benefiting from the scale of the alternative platform we have at JPMorgan? So what we have in terms of our real estate exposure is actually 40 billion of asset value across 232 assets. So really, really well diversified across the US and Asia Pacific. We like that split. One, it means that our UK focused investors don't have that domestic overlap they have with a lot of their existing portfolios, but also they're really complementary in terms of the markets. You have a very established US market, you have a growing and often evolving market in Asia Pacific, and it means you have very, very different trends that you can take advantage of. We focus mainly on the core sectors. You can see our split on the left hand side. Delighted to say that industrial is now our largest allocation. Took some time to obviously build that out as the industrial sector has really grown in prominence over the last few years. And you can see on the right hand side that we have still another 11 million square feet of industrial assets in our pipeline that should be added to the portfolio over the next roughly year time period. That's before anything else comes in, and so we expect that number to increase going forward. Office is naturally a large allocation. It is the largest sector within real estate. Maybe there's a question on this later, but generally we feel that the office market will evolve but not necessarily change dramatically like some people predict. We have been reducing that over the last few years anyway, and are relatively comfortable with that allocation. Residential and retail are slightly smaller allocations, and then you'll see at the bottom we have other real estate. Other real estate is a slightly obviously catch-all term, includes things like land that we own, but also in the listed side where we have that exposure to some slightly more extended core sectors like data centers, manufactured housing, is also included in that other real estate, very much more on the listed side where you have a greater prevalence of them type of sectors. So I'm thinking about where we're going, what we're focusing on going forward. Really what's happening within real estate is how the preferences of the millennial generation are driving what we do and how we think, how they live, how they work, how they shop. That's really defining what we want to own in the real estate side. I mentioned that means an increasing focus on industrial as you have more and more online buying. Just to kind of caveat that, as more and more retail space kind of dwindles, those that are left will get stronger. There'll always be a need for retail. And so actually, even though we are reducing the allocation, we do think there'll be a time when that market does stabilize. Also targeted residential opportunities. This is a really great way of thinking about how the different geographical allocations feed into some powerful trends we can take advantage of. So in the US, our big focus is increasing our single family housing allocation. That trend is really about the aging millennial generation that have families and want to move out of the city because maybe they only need to go into the office 2 or 3 days a week. Big conviction for us and something which is increasing. In Asia, the big way we're playing the residential side of things is Japanese multifamily real estate. Here we're focused on 1-bed and studio apartments in Tokyo and Osaka, because actually in Japan you have a very, very high level of household formation. That household formation is becoming because the Japanese kind of socio-demographic dynamic is really meaning that millennials are moving out of their family home at an earlier age than they used to. It's a really, really important level of demand, or increasing demand for that kind of 1-bed apartment that people need as they move out at a young age, and we are really targeting that. Moving on quickly, because I'm aware of kind of the roughly 30-minute presentation limit, but onto infrastructure and transportation, again, really, really well diversified. Again, 40 billion of assets, 609 assets. That number is slightly inflated because when you own something like a wind farm or a wind farm business, you have several wind farm locations that kind of add up to quite a large number, but nonetheless, really, really well diversified. Really, really strong level of yield as well. Since 2020 operational cash yield of 7.6% across these two strategies. JARA didn't benefit from that because we weren't yet invested, but something we can obviously look forward to going forward. And is a really nice complement to the slightly lower yielding real estate market. It means together we get a good blend of yield, and that's really benefiting from the slightly high yield in this part of the market. Importantly, we focused on operational cash yield because actually the headline cash yield number is slightly higher when you have things like return of capital. That operational cash yield is something which is the most repeatable part of what we're producing, so hence we're focused on that. But actually from a headline perspective, it can be a little if you include things like capital. You can see on the left-hand side that sector split. Utilities is a big part of what we do. I've talked about the benefits of that from an inflation perspective and a contracted return perspective. We have a good exposure to maritime on a look-through basis. That's a really diversified market. So container ships, product tankers, various other sectors that's good to have exposure to. Renewables is 5% of JARA, definitely part of the portfolio which is increasing. You can actually see on the right-hand side, again, because you kind of get that multiplication effect with JARA because we're actually owning more assets on a look-through basis than our AUM would allow. It's still 6 gigawatts worth of generating capacity. Millions of homes that will power a year, but it will increase. We are staying away from some of the more volatile markets from like you saw in 2020. So aviation is 5%. that has been reducing steadily as we've diversified away from that. And energy logistics is actually a relatively high conviction part of the market for us, where we have focus on things like LNG carriers that can be highly fuel efficient. We have focus on things like wind farm maintenance vessels. And so really, really good mix within this part of the portfolio as well. Finally, just a last couple of quick slides. We are a global portfolio. I think that's a really, really important point with JAR in terms of being a really good complement and a unique offering within the market. You can see on the left-hand side what our geographic exposure should be once we're fully invested. We are 92% invested, so we are nearly there. Roughly 50% North America, 30% Asia Pacific, and 20% Europe and UK, and a little bit of other. Importantly, JAR is a unhedged portfolio. So with that global diversification does come currency exposure as well. We have unhedged. We want to keep it simple, and that's generally what investors want. We launched back in September 2019. We can imagine sterling was really, really quite weak and has strengthened quite significantly since then. So that has been a drag on our sterling performance. So, even though we're down roughly 5% since inception, if you think about the fact that sterling dollar has moved from 123 to kind of 135 at our last NAV and continue to move, actually from a local currency perspective, we have been able to, eke out some positive return even during a difficult year. We are going to remain unhedged. I think it's just an exposure to highlight to people that they should be comfortable with. Hopefully that, the currency exposure will sometimes work with you, sometimes work against you. And hopefully over the longer term, things will kind of even themselves out. But it's something to highlight that people should be aware of. And with that, Tom, I will pause. There's one more slide on ESG, but maybe there's some questions on that, or we can touch on it if there aren't any questions.
Great. Thanks very much, Phil. Yeah, we had quite a few questions, but please do keep coming in. Keep them coming in. There have been a couple of questions sort of on the nuts and bolts of how you actually get invested. So can you tell us a bit about the process and why when you raise cash, you can't invest immediately and it takes some time? And then perhaps related to that, could you give a bit of indication on the C shares and when they're likely to remain invested, to become invested, sorry?
Yeah, so so the mechanism of the way JAR invests is basically underlying, we have a range of private vehicles which we allocate to. These vehicles will take commitments but will not draw down your investment straight away. They do that to protect existing investors, which we are now an existing investor on across the platform, because otherwise if you draw down before you find the assets, you obviously are diluting your return. So we only get drawn down as and when new assets are found to add to the portfolio. And importantly, JAR's underlying vehicles are seeing net inflow. So it's very much an adding game at the moment, as opposed to anything which is where we're seeing any sort of selling. That takes some time. So, typically what we generally see is a kind of 6-month drawdown on average, 6 to 9 month drawdown as you commit. Say, look, we've got X amount to invest. The teams go and find the investments and draw you down in an appropriate manner. That's kind of that slightly additional kind of runway to investment. One is relatively normal in the alternative market where things are illiquid. Maybe JARS is slightly more than normal just because we are going into these vehicles that give us greater diversification, but also take a slightly longer time to get invested. The other question around the C shed is, so we, I'm alluding to kind of cover those who aren't aware, we did kind of release a prospectus towards the back end of last year around the possibility of us doing a C share. It was a very busy time in the market when we released that in November. A lot of people come into the market trying to raise assets between November and the end of the year. And although we did get demand, a notable amount of demand from investors, it wasn't really the level of demand we wanted to really justify launching a whole new separate share class that would trade by itself and have to have its own liquidity. So our kind of focus on making sure investors have a good experience. We want to make sure that C share can be as large as possible. So we have postponed it probably into kind of the middle of the year when we are hopefully working with a couple of large investors to be able to launch that at a decent size. One thing I would say around deployment, is that obviously our initial IPO deployments was heavily impacted by COVID. There was effectively a 5-month period where we didn't deploy anything, which was not on our kind of radar at launch. I think there was good reasons for that. We delayed transactions, we cancelled transactions. To the extent that doesn't happen again, hopefully we won't need the full 12 months to get invested with the C share. It can be a little bit quicker, but it still will take some time.
In terms of the NAV since launch, so it's around 90p now. Can you talk us through what's driven that? Is that the impact of currency? And then perhaps a good thing to tie together. I mean, we had a few questions around the premium. Does the board have a policy on the premium and how that would close over time?
Yeah. So yeah, NAV I think is around 91, which is if you then add the income, obviously we paid out since launch, which has been in target to what we were targeting at the beginning, means roughly a kind of 4.5% decline or negative total return. That is all currency. JARA's exposure to dollar has been high since its launch. What you can see on this page, presuming people can still see it, is where we are when we're fully invested. So roughly 60% dollar. Our exposure, while we're waiting to get invested, has been actually $2. So our exposure today is probably averaged around 85%. So with the sterling dollar moving from as I said at launch 123 up to where it is now at 140, that's been a significant drag, which is obviously unfortunate, but nonetheless something I think hopefully we're clear about, and something people just need to consider when they invest. So if you take out that drag, actually performance, if you include the accretion coming from share issuance, if you include some of the positive performance we've seen in the private side that we've been invested in, we have actually had positive local currency return. It's just been a currency drag, bringing that NAV down in sterling terms. The other question, Tom, apologies. You're on mute, Tom, sorry.
Fantastic. Last session of the conference. The second part of the question was around the premium, and is there a policy around reducing that over time?
Yeah, so I think to make people aware of how it's evolved, I suppose. So yeah, currently trading at 9% premium, which is actually broadly in line, I think, with where it's been on average since launch. During the first kind of 6 to 9 months of JARA's life, we were issuing shares to moderate that premium. There is, however, a balancing act with that, where with COVID particularly going on, we had lower visibility than we'd like over our deployment timescale. And so we were effectively adding cash. We didn't want to add too much cash into the vehicle without good conviction about where it can go. So we have paused that share issuance for the time being to get more fully invested. And now we're there. We're over 90% invested, which is great. And bearing in mind, we have fully invested IPO proceeds. And what we're now investing is the issuance since launch, which has been done at a premium to NAV. So it's been an accretive round trip for investors. It hasn't taken us a year and a half to invest the IPO proceeds. We did that some time ago. Going forward, I think the way you moderate the premium is obviously increasing the supply of shares in the market. Our current focus on doing that is through the C share. And typically a C share, as and when you go and do that, does help moderate the premium, because it obviously gives people a chance to buy in at close to NAV, or pretty much at NAV when that share class is launched. Once we've done that C share, I think there will be we'll have more flexibility to again start issuing shares to moderate it, and obviously with the liquidity portion if it's needed to buy back on the other side. There is no formal policy at this time, but I think once the C share is out of the way, there will be greater flexibility to do something like that when there's demand.
We had a couple of questions around the impact of the pandemic. So as you alluded to, one area of controversy is office property, but also perhaps transport assets or other parts of the real estate assets, changes in working habits, attitudes to travel. Have you had, has that caused any change of thinking in your long-term assumptions?
So this might be a long answer, so it might even take us time, apologies. But a lot of the trends which have been driven by what's happened with the pandemic are not new, particularly within real estate. So they have accelerated our action, they've accelerated our thinking, but they haven't changed the general trend of where we thought things were going anyway. We were already reducing retail significantly. So in 2019, we sold 3 billion of retail. Very good time to sell it. We've reduced our office allocation over the last 10 years. And even though it looks quite high still, a lot of that is now specialized office, things like life sciences, labs that are more targeted to certain types of industries that are seeing quite good demand. So it hasn't changed the thinking, it's accelerated what we do. Logistics was, again, part of what we were building up, and we will continue to do that. From a long-term perspective as well, our strategic asset allocation has broadly remained unchanged. We don't see any significant changes in the dynamics of the markets. If anything, from when we launched, when we were late cycle to where we are in a new cycle, we're probably even more bullish on real estate, which tends to do relatively well in an earlier market environment. We were always prudent around our allocation to aviation and kind of fixed transport assets like airports and seaports anyway. So, if you'd have asked me where our allocation would have been to aviation by now, I'd have said it probably a couple of percentage points higher, but not much. We turned down a few. So we had a range of aircraft in our pipeline that we were supposed to acquire in 2020. We did actually cancel them acquisitions and decide to diversify away from it. But nevertheless, I really don't see aviation ever being a significant part of what we do, mainly because the counterparties you get in that space aren't as good as what you can get in the maritime space, where you can face off against energy majors and the likes. So even though we think it's a good part of the portfolio, it's fundamentally something we always envisaged to be a smaller part. So nothing changed there apart from, again, drifting away from it by diversifying into other sectors. Airports and seaports is an interesting one. Not much exposure there, but yeah, it definitely has been a pain point for us in underlying strategies. Airports in particular, again, you get differentiation between airports that do much more domestic flights versus airports that do much more international flights. Market that's gone through a lot of change. Probably, if anything, an opportunity at some point towards the end of the year. We don't think that's a fundamental change, a bit like we don't think there's going to be a fundamental change in office. So if anything, hopefully give us a buying opportunity at some point in the future. To finish off on office, a quick comment, because I just want to touch that because it's a big question we get. Office, it's not a zero-sum game, which I think people often think about. People say, oh, people are going to go into the office 3 days a week as opposed to 5 days a week. There's going to be a lot less need for office space. There may be some reduction, but if you're anything like myself, when the offices were open a few months ago, you were going in when you go in Tuesday, Wednesday, Thursday, and you work from home Monday and Friday. And if the rest of the workforce is like that, if your business, actually on a Wednesday, 95% of your workforce will likely be in. And therefore your drop off in office space needed isn't going to be as much as 40%. The other thing to note is that the percentage of people who do office jobs is increasing. So even if we work from the office less and there's less office needed, that will to some extent be buffered by the fact that generally more people in developed economies are doing office jobs. So we are cognizant of things evolving, but don't think there's going to be a need to totally reduce your office allocation via SAL.
And as you say, your asset allocation is intended to be fairly stable, but there's been a bit of a question about how you would go about rebalancing over time if you did. What is the approach? How does the committee work?
Yeah, so we have an investment committee in the Alternative Solutions Group. We have several multi-alternative portfolios we run for different clients, both on an advisory and a discretionary basis, obviously each with their own objectives. With JARA, obviously unique in its own way, one of the best ways for us to obviously change our allocation is with inflows. So, for example, those who have looked at the C share would know that there was an intended slight shift in our allocation with the C share, where we look to not increase our allocation to real estate, but diversify within the current bucket to include a bit of real estate debt. We like that because it's a market that's been impacted by COVID. So you're getting a 6 to 8% net yield at a more senior point in the capital structure to purely owning the equity. Inflow is the best way to do that, obviously with allowing you to rebalance quite easily. We, as an investment committee, will take a vote on that during our typically monthly or quarterly meetings. We would normally present that to the board as well, and once that is kind of approved or reviewed, we can then go and enact that. We do have other mechanisms. So obviously, JARA being a kind of income producing focus does have liquidity from the income streams. So we could either use that income stream or the liquid portion to rebalance as well. And finally, the underlying strategies do offer us liquidity. There are modest lockups of typically between 2 and 4 years in the underlying strategies, which is quite normal for this type of asset class. But once they're through, we can serve redemption notices and move things. That will take typically 6 months to do. But if we have a longer term view, that's obviously something we can definitely enforce.
Now, we've seen in recent months a big rally in various sectors that seem to be beneficiaries of fiscal stimulus in the United States in particular. Would JARA potentially benefit from either the US's current plans or a more general global push for fiscal stimulus?
To the extent there is obviously a rebound in economic growth, whether it's in the US or on a more global basis, there will definitely be portions of JARA's portfolio which will benefit. Typically, our fundamental return stream, which is the long-term contracts, are relatively fixed in, which is positive when you're thinking about downside protection. And to the extent that leads to things like inflation, there are a lot of mechanisms that allow us to benefit from that. So yes. Where we've seen the most benefit more recently is where we do have a bit of a listed allocation. You've seen strong rebounds in the transportation names and some of the REIT names, and we have been a benefactor of that. More broadly, kind of if you look at where a lot of the fiscal stimulus is going, there's obviously both in the US and Europe a focus on the energy transition and kind of moving these economies into more renewable energy parts of the market. We do expect to see some trickle down impact of that. Typically, governments still do a lot of infrastructure spending themselves, and that doesn't necessarily always impact the private markets. But to the extent there are tax benefits or general stimulus focused towards greater building or operation of renewable assets, that should benefit the private markets that we're focused on. Actually, more recently, with the Biden administration coming in, you've seen the actually renewable energy market in the US get really quite hot. So we've actually shifted our focus more recently to Europe, where you're seeing right now a little bit less competition for the acquisition of these assets. But typically every year or so, you would see a switch between the two regions in our view, because different focuses at different times mean that opportunities come up that you want to take advantage of. But again, that's another way we think that the opportunity set will evolve from that government spending.
Thanks. I think one more question that's come in, but just as a last kind of call for questions, if you do have a final question, please put it in now. There's a question around sort of regulatory risks. Do you have exposure in the portfolio to government action, to regulation, and if so, where would they be?
Yeah, so we do. I would say one of the biggest exposures of real assets or one of the biggest risks within real assets is regulatory risk. Whether it's or local, let's call it local risk, whether it's political risk, regulatory risk, local market dynamics, and we do have that. What I think is different about JARA is it's a global portfolio. I don't think there's actually any way to get out of being exposed to that regulatory risk within the real asset market. It's more about just diversifying or being comfortable with it. So by being obviously focused first on developed markets, we have greater kind of visibility about how we think governments will act. But also, we aren't beholden purely to what the UK regulator or UK regulators, depending on diversification is, think about how they should, impact the returns of utility operators going forward. That is definitely an exposure, but we also have exposure to the US and Europe. In a way, Europe and US are great markets to be in, which is where the majority of our exposure is. We only have 3% in the UK because they're much more fragmented. In the US, as we've seen with a lot of the political goings on over the last year, it's a very state by state market. What goes on at the federal level is important, but not really as important as how California or how Texas decide to act. And that's our regulatory risk, actually. And so you can see that even if we have a US utility exposure, we could diversify that by being in 10 different states and therefore having 10 different regulators, or even more than that often, that are making decisions about us. So yes, we have it. Our way of dealing with it is more of a diversification point than anything else.
So we had a quick question around the annual return, which I have a feeling we may have mentioned earlier. I think the return target is 7 to 9% NAV, roughly half of that from the dividend.
Yes, roughly. So 4 to 6% is the dividend target. Dividend paid quarterly. Last quarterly dividend was 1p. So that was an increase from where it was before. So now, if you analyse that, we are at the lower end of that target. But Jara are now really getting into kind of the fully invested part of its life cycle. So hopefully able to move up from there as well. Great.
And then perhaps finally, we did have one question about the ESG slide. We just asked if you could share. So maybe you could give us the
I will. So I've run out of time, so I thought best to do some questions. So nice thing about real assets is obviously the tangible nature in which you can really show and really get exposure to the ESG side of things. Even though you can see that our renewable exposure, for example, is 5%, that is over 6 gigawatts. That's millions of homes being powered on an annual basis. We also, for example, in the transportation space, which is a market you don't necessarily think about as being an environmentally friendly market, we are pioneering, looking at building brand new assets that either use battery power, use LNG as a fuel. One asset that we are currently building in what is a public partnership with Shell is a LNG carrier that should be significantly up to 60% more fuel efficient than an equivalent asset that is 15 years old. So a lot of really good tangible things from a sustainability perspective. What I've been highlighting more recently is what we show on this slide, which is actually the social side of things. People focus on E a lot. Governance, asset managers are focused on, for decades. Social is often the least tangible. Not in 2020 though. 2020 was a year where if you didn't get the S right, a lot of people were, in unfortunate positions that, we were in a position as a provider of public services, as a person that operates ships, that we were fundamentally impacting. So, for example, during kind of February, March time, our crews were going from country to country and not being allowed off of ship. The work we did with them to give them extra bandwidth, extra pay, to allow them to at least live in that situation in the most comfortable way was really, really important. Where we operate utility assets, we had a commitment not to cut off any people that were on kind of short-term hardship because not being able to pay their bills for a short period of time. We've stuck to that throughout 2020. Other thing which I think resonates quite well here in the UK, was actually in Australia, but big program. We didn't need a lot of the laptops in the office anymore, so we gave them to the local schools. So a lot of examples where in 2020 the S became more tangible, and because we're running these real assets that are part of society and impacting into people's lives, we're able to make that make the right decisions hopefully, and make that difference. So is a part of what we do. We are not going to stop owning certain assets. We don't have exclusions, but we are focused on it. All of our strategies we allocate to are ESG integrated, and this is just kind of one example of how that plays out.
Brilliant. Well, thanks very much, Phil, for your time, for your presentation and answering the questions. And thanks once again to the audience for your attendance this week. Much appreciated, and we hope we will see you at events in the future. We will put any questions that we didn't manage to get through to the manager on your behalf after the call, and hopefully we'll have a write-up of the event with slides and other information coming shortly. So thanks very much, Phil.
Brilliant. Thank you, Tom. Thank you all.
And thanks. Bye-bye to everyone.